$405,400. Here's a number that should terrify you. That's the median existing home price in America as of December 2025. And here's another one, about 6.1%. That's the average 30-year fixed mortgage rate in late January 2026. If those numbers sound manageable, you're about to watch your money evaporate in ways most people never calculate before they sign a contract. Because in 2026, the U.S. housing market isn't just expensive, it's a mathematical trap, especially for anyone who buys first and does the math later. And the first trap is something most people don't see coming: lock-in effect. Here's what it means. In 2021, millions of homeowners locked mortgage rates around 3%. Today, rates are roughly double that. So moving isn't just changing your address. Moving is trading a cheap mortgage for an expensive one. Let me show you the math. Picture this. You borrowed $400,000 at 3.2%. The principal and interest payment is about $1,730 per month. At about 6.1%, that same $400,000 costs roughly $2,424 per month. Same loan, different universe. That's roughly $694 more every month, or about $8,328 more every year for the same amount of borrowed money. So what do people do? They don't move. They stay put. They're locked into their homes by their own low interest rate. And the data backs this up. A huge share of outstanding mortgages are still at or below 4%, so sellers become scarce. And that creates the second trap: inventory. As of late 2025, the market had about 3.3 months of supply. A balanced market is often closer to 6 months, so you've got buyers who want to buy, but you have sellers who can't afford to sell, which is why prices can stay stubborn, even when people feel priced out. That's the inventory illusion. It looks like a normal seller's market, but underneath, it's a frozen market. Now here's the trap that hits your budget directly. Most people think the mortgage is the payment. It's not. The mortgage is only the beginning. So now let's talk about the math you need to understand before you buy. And we're going to use something called the 5% rule. It's a framework popularized by Ben Felix and PWL Capital, and it forces you to price the real cost of home ownership, the costs that do not build equity, costs you simply pay year after year. Here's the idea. Every year, you lose approximately 5% of the home's value to 3 buckets: property tax, maintenance, and the cost of capital. Let's break it down. Number 1, property tax. A practical rule of thumb is around 1% of the home's value per year. It varies a lot by county, but it's not optional. So on a $500,000 home, that's roughly $5,000 per year, or about $417 per month. Number 2, maintenance and long-run repairs. This is the one buyers love to underestimate. Roofs fail, HVAC dies, water heaters break, appliances wear out, everything depreciates. A practical rule of thumb is around 1% per year. So again, on a $500,000 home, that's about $5,000 per year, or about $417 per month. And yes, some years you spend nothing. Other years you get hit with a $15,000 roof, and it wipes out multiple years of budget. Number 3, cost of capital. This is the sneaky one. It's the opportunity cost of your down payment. Put $100,000 down, and that money is no longer invested elsewhere. Long-run stock returns are often quoted around 10% nominal, not guaranteed, but useful for back-of-the-envelope math, so that $100,000 could be growing by about $10,000 per year in expectation. Instead, it's tied up in the house. And if home prices are growing in low single digits, the gap between those growth rates is a real cost, now added up on a $500,000 home. Property tax, about $5,000 per year. Maintenance, about $5,000 per year. Cost of capital, about $10,000 per year. Total, about $20,000 per year. That's roughly $1,667 per month in costs that do not build equity. And notice what we have not included yet: the mortgage payment, insurance, HOA fees. So if you look at a mortgage calculator and think you understand the full cost, you don't. Not even close. Now let's make it concrete. You have $100,000 saved. You're deciding, do I buy a house or do I rent and invest? Scenario A. You buy a $500,000 house. You put $100,000 down. You borrow $400,000 at about 6.1%. Your principal and interest payment is roughly $2,424 per month. Now stack the real costs. Property tax, about $417 per month. Homeowners insurance, about $150 per month. Maintenance and long-run repairs, about $417 per month. So the all-in monthly cost is about $3,408 per month. Scenario B. You rent a comparable place for $2,400 per month. You invest your $100,000 down payment in a broad stock index fund, and every month you invest the difference, about $1,008 per month. Now fast forward 10 years. If you buy, assume the home grows at about 3% per year. $500,000 becomes roughly $672,000. After 10 years, you still owe a lot on the mortgage, around $336,000. So your equity is roughly $336,000. But if you sell, you pay transaction costs. Fees vary, but selling costs are still commonly a meaningful percentage of the sale price. So let's use a rough assumption of about 5%. On $672,000, that's about $33,600. So your net position is roughly $302,000. Now, if you rent and invest, let's use a conservative stock return assumption, about 7% per year compounded. You invest the $100,000 up front, and you invest $1,008 every month. After 10 years, the portfolio ends up around $375,000. So in this example, renting and investing comes out ahead by roughly $70,000. Now, before you rage in the comments, yes, this can flip. That's the point. So let's stress test it. If home prices grow at 5% instead of 3%, buying looks much better. If stock returns are lower than 7%, investing looks weaker. And if you refinance to a meaningfully lower mortgage rate during that window, it can save tens of thousands of dollars and narrow the gap. Here's the bottom line. Buying tends to make the most financial sense when at least one of these is true. Home price growth is unusually strong. Borrowing costs fall meaningfully, or you stay long enough that the economics have time to work. And in many expensive coastal metros, the price to rent math is still brutal. In a lot of places, renting is simply cheaper than buying on a monthly basis before you even factor in opportunity cost. So the answer isn't never buy, and it isn't always buy. The answer is run your numbers in your market. All right, here's your checklist. Before you buy a house in 2026, do this math. Number 1, calculate your local price to rent ratio. Take the home price you're considering and divide it by the annual rent for an equivalent place. If that number is above 20, renting is often financially favored unless you have a strong reason to buy. Number 2, run the 5% rule. Add property tax, maintenance, and the opportunity cost of your down payment. If that number alone makes you uncomfortable, listen to it. Number 3, compare it to investing the difference. Use a compound interest calculator. Try 7% for stocks. Try 3% for home growth. Then stress test it. Number 4, check your holding period. If you're not staying at least 7 years, transaction costs can destroy returns. This is not a short-term play. Number 5, stress test your life. What if you lose your job? What if rates don't drop? What if home prices fall 10%? Can your budget survive? Look, I'm not anti-home ownership, But 2026 is not 2019. It's not even 2021. The math changed, and if you don't adapt, you can lock yourself into a payment that controls your life for decades. Home ownership can be incredible if the numbers work, but it's one of the biggest financial decisions you'll ever make. Treat it like one. Run the math. Be ruthless. Be honest. And don't let emotion or social pressure make a $250,000 decision for you. If this was useful, hit like and subscribe for more data-driven breakdowns. And comment 4 things: your household income, your current rent, your down payment, and your city. I'll pick a few real scenarios and run the numbers step by step in the next video. Thanks for watching. I'll see you in the next one.